Hi everyone, good evening. You're all very welcome to this evening's webinar, which is focused on navigating redundancy, getting to know your options. Really appreciate your time coming on this evening. We'll just give it a couple of seconds there just to allow more people to get on. But for anyone on the call tonight who isn't aware of who I am, my name is David Looney. I work as one of the financial planners here in Alpha Wealth. I'm sure I don't have to tell people on the call, but the topic of redundancy is something that's, really prevalent at the moment as more and more Irish employers have announced a lot of layoffs. This is actually the fourth redundancy webinar we've done over the last 12 months, and we were just looking at the numbers recently, and we can see that over 4,000 people have registered for the four webinars over the last 12 months, which just gives a bit of an idea of how prevalent it is at the moment. But I think irrespective of whether you are somebody who's maybe facing the prospect of a redundancy or is in that process already, or even somebody who just thinks that it might be down the track for them and they just want to know what their options are, it's really important that you arm yourself with the information and just get some impartial advice. So look, hopefully we can educate everyone on the webinar today as to what they're entitled to, how the calculations are done, and just basically some impartial advice to get you into the best possible financial situation. So for anyone on the call who might not be too familiar with Alpha Wealth, who we are, what we do, we basically run an impartial financial services company headquartered in Little Island in Cork. We've 10 advisors based in Cork and Dublin who provide straight talking financial advice, which is basically giving advice to people like yourselves, families like yourselves, business owners, to just basically help you manage your money more effectively and put plans in place to take care of your financial future and take care of any financial objectives that you might have. We currently have built up a good client base of over 4,000 clients over the last 11 years. We are now managing a portfolio of over 400 million of assets under management across our client bases. So myself and my colleagues on screen have quite a lot of experience in helping people manage their money. These are just some of the colleagues in our team, and I am joined by some of them this evening, including Ruth Murray, who will be looking after the Q&A and the chat box. So if anybody has any questions throughout the webinar, look, we'd like to make it as formal as possible, so feel free to pop in any questions there, and we'll get to them throughout the webinar, or we'll leave a bit of time at the end as well, of course. So firstly, just to summarize what we're going to be covering in this evening's webinar, when it comes to redundancy and severance packages, firstly, we'll be looking at what you're entitled to and how is that calculated. We'll be looking at the various tax options around your lump sum and how that potentially impacts your redundancy payout and also your retirement benefits. We'll be looking at ways that you can reduce or offset some of the tax on that redundancy payment. And then we'll just be, wrapping it up or encompassing it all within kind of general financial planning and retirement planning advice. So firstly, just to start off, it's important to get your ducks in a row if you are facing the prospect of a redundancy, okay? And without blowing our own trumpet, I think it is really important that people maybe meet with a financial planner just to review your current financial situation. We'll have a look at your current situation, your expenses, your outgoings, and sometimes it's just a case of giving you a bit of reassurance that your financial position is supportive of taking a bit of time off work. I've met a lot of clients over the last couple of years who I've helped them navigate through the process of redundancy. Some of them see it as a bit of a benefit because it gives them a bit of a cash injection to take some time off work, maybe go traveling, maybe clear their mortgage or spend some time with the kids. And some of them, see it as a really daunting prospect and they don't see it in the same positive light. But irrespective of what side of the fence that you find yourself on, it is really important to get your ducks in a row and get some specific advice on your situation. Now, if you're not directly moving into another employment, we would recommend that you also register as unemployed with the local social welfare branch. Dependent on your PRSI record, you may qualify for job seekers benefit. I'd say a lot of people on the call today would qualify for it, even if you're taking voluntary redundancy, and that's a payment of €232 per week, which is payable for a period of 6 to 9 months, and then you have the option to reapply for it. Now, if your redundancy package is over a certain threshold, you are disqualified for applying for job seekers benefit from a period of 1 to 9 weeks. So if the payment is over €50,000, you are disqualified for that initial couple of weeks. weeks, and there is a scale. So basically, if your package is over 100,000 net, you're disqualified for the maximum 9 weeks. So look, it's not that long, and I suppose taking into consideration, the amount of money that people can potentially be getting. Now, if you don't meet the social insurance requirements, the alternative is something called job seekers allowance, which is means tested. Now, it's not something that Alpha Wealth deal with directly, but you can find out some really good information on citizensinformation.ie. It's a very good website which takes you through the entitlements and how to go about claiming. So I would encourage everyone on the call, if they are impacted, to maybe check that out.
David, sorry to interrupt you there. There's just one
Yeah.
question on that previous slide. So it
Yeah,
says,
sure.
just in relation to the 50K, it says that 50K is net. Is that what I heard?
Yes, I believe it's net. Yeah. So if your total redundancy package is over 50,000, you have to wait potentially a couple of weeks before you can apply for job seekers allowance. And I think the maximum wait time is 9 weeks, and that applies to people who've got over 100,000. So if your package is somewhere between 50 grand and 100 grand net, it'll vary depending on 1 to 9 weeks. I would say probably 50,000 is one, and it goes up in a scale. Perfect. So if we look at redundancy packages and what they're made up of, they're usually broken down into 2 to 3 elements. Okay, firstly, you have something called statutory redundancy, which is kind of what you're entitled to by law, and that is 2 weeks gross pay for each year of completed service in your employer, plus a 1 additional week's gross pay. Now, it's worth noting that the weekly payment is actually capped at €600. So even if you're earning in excess of €600 per week, you can only use that in the statutory redundancy calculation. It's worth noting also that all of statutory redundancy payments are exempt from tax. You then have something called ex gratia redundancy, which is based on the discretion of your employer, or maybe written into your employment contract. It's usually kind of an incentive-based payout. We've seen, various different examples of it, like, 4 times salary or 4 times weekly pay by years of service, or 6 times weekly pay by years of service. So it really depends. I suppose it differs from company to company. Now, with ex gratia redundancy payments, part of it is tax-free, a part of it can be taxable at your marginal rate, and the amount that is tax-free can come down to a series of 3 calculations, which we'll be looking at later, to determine how much of somebody's redundancy payment can be exempt from tax. Now, depending on your employment situation, your severance package might also include things like payment in lieu of notice, any holidays that you haven't taken, any accrued bonuses that you're due. All of those guys just go through payroll in the normal manner, where they're subject to income tax, USC, and PRSI. So the exemptions that I mentioned earlier do not apply to that. But there may be ways to reduce the impact of tax on these kind of things by maybe making a last minute pension contribution. And we'll be talking a little bit more about that in the later stages of the webinar as well. So just so it resonates with people, and just to look at the numbers which drives a redundancy situation, I think it's always just helpful to look at a real life scenario. So we've a 30-year-old here, Joe Murphy, and the 5 bits of information that you'll need to know and we'll need to know when it comes to calculating your redundancy package, as well as your tax-free exemptions, are your current total earnings. So your, say, a salary for this year, what your total earnings were over the last 3 years. So you should be able to get those figures either from your employer or by downloading the employment detailed summary on your revenue.ie, your years of service in your company, your current pension value, which relates to your current employment, of course, and the present day value of your pension tax-free lump sum. Now, I appreciate people mightn't have the last 2 ones there at the hand, but you can get them probably really easily by either logging on to your online portal for your pension, or else by contacting the pension provider, and usually the actuaries will be able to provide you with a present day value of your pension tax-free lump sum. And it might be provided by your employer as well as part of the redundancy options that they give you. So for Joe here, his statutory redundancy is his €600 capped weekly pay, multiplied by 2, multiplied by his 9 years of service, plus 1 additional week's capped gross pay, which gives us a figure of 11,400. So all of that payment is tax-free for Joe. And then his ex gratia payment, I'm just using as an example here of weekly earnings by 6 by years of service, which is a common one I come across. So we take Joe's weekly earnings, that's not capped, of course. So it's 1,192 multiply by 6, multiply by his 9 years of service, gives us a figure of 64,368. And as I mentioned, some of that will be tax free and some of it will be exempt from tax, and the amount that is exempt from tax, it comes down to a series of 3 calculations with the highest answer equaling the tax-free entitlement. So don't get too bogged down with the calculations, okay, because there's a lot of numbers going on. A lot of the employers who will give you, let's say, a retirement option statement, or maybe some of the accountancy firms that are employed by the employers to give redundancy option statements, they'll usually just say option A, option B, and all of the calculations will be in that. But it's good for you to get a sense of what's driving those calculations. Firstly, so you can understand it a bit better, but also so you can verify it, and just to make sure that they haven't made any mistakes. And I have done this for a lot of clients, and I can do it for anybody who wants to engage with us after the webinar, just to make sure that all of the calculations are correct. So the first calculation is something called the basic exemption. Then you have something called the increased exemption. And then we have something that is a bit of a mouthful. It's the standard capital superannuation benefit, but the abbreviation is SCSB. So the basic exemption is calculated as €10,160 in addition to €765 for each year of service. With that option, you can continue to be eligible for your retirement tax-free lump sum payment from your pension. You then have something called the increased exemption, which is basically the answer of the basic exemption above plus an additional €10,000. But that increased exemption can only be used if you haven't received a tax-free lump sum from your pension in the last 10 years, aren't currently drawing down your pension tax-free lump sum, or you haven't used an increased exemption in the last 10 years. And then the final one is the standard capital superannuation benefit, the SCSB one, which is a bit more complex. It's your average annual earnings, which is why I was saying that we need that earlier. So your average earnings for the last 3 years or the last 36 months, multiply by your years of service and divided by the number of 15. Don't ask me why it's divided by 15, but that is the calculation. Now, it's worth noting, okay, that if you are going to use the increased exemption or the SCSB calculation, you're actually giving up your right to take a tax-free lump sum from your pension that relates to your current employment on retirement. Whereas if you're using the basic exemption, it doesn't involve waiving your right to a pension lump sum. Now, just to give people a bit more information on what I'm referring to. So if you have an active pension scheme in your employment, if you leave your service, that pension will stay invested. It'll continue hopefully growing tax-free until your retirement. And at say 60 or 65 or 55 or whenever you decide to retire, you're usually entitled to take a tax-free lump sum from the final value. That's usually about a quarter of the pot, so about 25% of the future value. Whereas if you're taking a redundancy payment now and you want more of that payment tax-free now, it often involves waiving a right to take a tax-free lump sum from your pension on retirement. And that's why the increased exemption or the SCSB calculation, which would usually give the higher exemption, would involve that. So for anyone who is maybe with an employer for a good number of years or who is earning, decent enough salary levels, it's probably the SCSB calculation is going to spit out the highest exemption figure. But you actually have an option to subtract the present day value of your tax-free lump sum from your pension from the SCSB calculation to therefore retain the right to the pension lump sum. Because if you think about it, if you take away your current tax-free lump sum value from the SCSB calculation, you're reducing the exemption amount and then therefore making more of the redundancy payment liable to tax. Whereas if we're using the full SCSB calculation and not taking away the pension lump sum value from that, it means more of the redundancy payment, it means less of the redundancy payment is liable to tax because the exemption figure is higher. And as I said here at the end as well, it is very, very important to get these calculations verified for a third party, just to make sure that nobody is making any mistakes and you're not missing out on any money.
Sorry, David, just to quickly jump in there. There's just one quick question.
Yep.
Can I still take up to 200,000 euros from my pension as a tax-free lump sum if if I received a tax-free redundancy payment?
Yeah, so firstly, people get confused with this, okay? When it comes to retirement, you're entitled to take 25% of your pension pot, usually as a tax-free lump sum, but it's subject to a maximum of 200,000. Now, the exemptions that apply to severance payments are completely different. They're an exemption rather than this 200,000 that extends to pension lump sums. However, if you use a higher exemption or the SESB calculation, the full amount, and waive your right to a pension lump sum, then that is going to impact how much you can take down the line. So look, I hope that answers it, but look, hopefully over the course of the webinar, I'll give you a bit more clarity on it anyway. As I said, look, I'm sure a lot of people might be completely lost with those calculations that I've just done. So let's apply them to, a real life example, and just so we get a better understanding of them. So if you take Joe here again, his total earnings are 62 grand. His average annual earnings for the last 3 years are 53,333. He's 9 years of service. Pension is worth 60 grand. 25% of that is 15 grand. So we'll say that's the present day value of the tax-free lump sum. There is another way of calculating it, which look, I might deal with in a second. And his total package is 75,768 euro, which is made up of 11,400 statutory and 64,368 ex gratia. So his basic exemption is basically 10,160 euro plus 765 euro for his 9 years of service, which gives an exemption figure of 17,045. His increased exemption is therefore the basic exemption plus an additional 10,000, which gives us a figure of 27,045. So if Joe is going to use the increased exemption, he needs to waive his right to the pension lump sum on retirement, or he can use the SESB calculation, which is his average earnings for the last 3 years, a figure of 53,333 euro, multiplied by his 9 years of service and divided by 15, which gives a figure of 32,000. So in this case, it's the SESB calculation, which is giving the highest exemption figure, and that's the amount that Joe can, waive off his tax. But if he takes the full exemption figure, he's waiving his right to a pension lump sum. Now, let's say he feels very strongly that he wants to retain his right to a pension lump sum. In that case, you would need to subtract the current pension tax-free lump sum value, which we're saying is 15,000, away from the 32,000, which now only gives a figure of 17,000. So you'll notice in this particular example, it would actually be the basic exemption that's giving a higher answer, and therefore you would be using the basic exemption if you want to retain your right to a pension lump sum, or the SESB full calculation if you were happy to waive your right to the pension lump sum. It doesn't always work out like that. Sometimes if you have a higher SESB calculation, even after you take off your pension lump sum value, the amount left over will be higher than the other two calculations. So it really kind of differs. So in Joe's case, as I said, his highest exemption is the SESB at 32 grand if waiving his pension lump sum, or the basic exemption of 17,045 if not. So basically his net payout if he wants to waive his right to a pension lump sum is 59,584. Or if he doesn't want to waive it, it would be 52,106. So there's a difference of about 7.5 grand. Now, some people might be asking where I've got those figures from. Where I've got the figures from is that, So basically, it's his ex gratia payment, taking away the exemption figure, and the balance then is liable to marginal tax, which is likely at 52% based on his income tax position for that year. So that's 40% income tax plus USC and PRSI. So basically, the amount is that he gets to hold on to is the statutory, the exempt part, and the after tax amount of the amount that's not exempt to tax. Okay, so in that particular case, there's only a difference of 7.5 grand. So of course, the $1 million question for Joe is it worth it? And an important question for maybe a lot of people on the call today, if they are facing the prospect of redundancy, is does it really make sense to waive your right to a pension tax-free lump sum? It really boils down to what the difference in the calculations are. For some people, it might be a very small difference, or for some people, it might be a very large difference. I met a client the other day that the difference was about €30,000. Whereas with Joe, it's about 7,500. Now, it really depends on somebody's need for cash now. If somebody's in, dire need to accumulate every cent they have, they might be inclined to take the higher amount of the redundancy payment now. But in a lot of cases, you can actually be shooting yourself in the foot by taking the higher amount now. Because remember, one benefit of pensions is that they accumulate tax-free over very long periods of time. So if you take Joe, he's 60 grand in his pension, and let's just say it grows at a 6% average return for the next 30 years to get him to his 60th birthday, that would be a future fund value of €344,609 with compound interest. 6% growth is a very, very reasonable return, by the way. You would be expecting pension funds to deliver more than that if they're doing what they should do. But as I said, at retirement, he's entitled to take 25% of his fund as a tax-free lump sum, which would be a pot actually of about 86 grand tax-free at his 60th birthday. So it's a case of saying, do I want 7,500 more now, or do I want the option to be able to take potentially 86 grand tax-free from the pot at my 60th birthday? Because remember, that gives you a lot of options down the line. He could wipe out any residual debt or mortgage that he has to maybe facilitate an early retirement, maybe use it towards the purchase of a property or a holiday home, or use it to travel. So for the sake of an extra 7,500 now, is it really worth it when he's going to get over 52,000 anyway by using the lower exemption? The answer for one person will be completely different to the other person, and that's why it is really important to get independent advice on your specific situation and see how either option is going to impact your longer term financial planning journey. Please do not listen to any of your colleagues, just somebody in the canteen who says that they're going to do a certain thing, so you should do a certain thing. As I said, no two people have the exact same financial situation. So just before I move on to that, by the way, because I'm sure somebody will ask me in a second, there is actually a bit of a loophole, okay, where you can have your cake and eat it as I describe it, okay? And that's basically that people have an option to take the higher amount of their redundancy payment now, so use the full SESB calculation, let's say, and they sign the waiver basically that they're giving up their right to their pension lump sum. But what you're actually doing is you're waiving your right to a future tax-free lump sum from an occupational pension scheme. And there is a bit of a loophole whereby if you do that, leave your company, and then move your pension to something called a PRSA, a personal retirement savings account, the way a PRSA is defined in pensions and revenue legislation is that it is a personal pension, and anyone that has a PRSA under current pension rules is still entitled to take 25% of the value as a tax-free lump sum when it comes to retirement. And so that is a bit of an anomaly in current pensions and tax legislation. I've done this for clients. It's completely within the rules. So if anybody on the call has maybe a situation where the amount between waiving their right and not waiving their right is very, very, very large, let's say 30 grand, you might be, pushed to go down this route, and I can advise people on that. What does it involve and what is the risks? Well, what it involves firstly is you need to get something called a certificate of benefit comparison to transfer an occupational pension scheme to a PRSA. It costs about €1,500. It needs to be done up by a third party actuary. And also, I suppose there is the risk, let's say, that revenue could close the door on it down the line, or they could pull back on this loophole. It's widely used, by the way, and it's well known about. We've had multiple finance bills over the last couple of years, and revenue still haven't closed the door on it. But it is something, look, that people should bear in mind, that it is a bit of a loophole currently completely within pension rules to go about that. But as I said, look, some people don't want to take the risk, and if there's not much difference in their payout, look, it might not be worth it given the fact that they have to pay for the certificate of benefit comparison. But for other people that are looking at a large tax bill, they might be I suppose tempted to go down that route, and we can advise on that, of course. Just checking, is there any questions there, Ruth, that are worth addressing so far?
Yeah, there's one actually on ABCs there, and there's been a lot of questions come in so far. So the first one is, can some or any of a redundancy payment be paid into ABCs if you're already paying the max allowed through payroll?
If you're already maxing out your pension to the age-related limits, no, you probably can't put any more of your redundancy payment into a pension. Um, you do have an option to max out for a previous year as well. So if you only recently increased your pension contributions to the maximum, but you didn't max out last year, you might be able to backdate some scope to last year. But if you're already maxing out, unfortunately, that's it.
Correct. And then I have two questions here. They're not in relation to ABCs, but they're in relation to job seekers payments. So
Yeah.
are job seeker payments increasing from the end of March so that they are linked to previous salary? And similarly, sorry, are there new social welfare benefits coming into effect on the 31st of March?
Yeah, possibly. As I said, look, it's not something that we would deal with directly, but I think there might have been slight increases in the budget last year, so that there might be a slight increase in those figures I gave. And I do believe you have if you have a qualifying dependent, let's say, there's an option to get an increased payment as well. So citizens information look should cover all of the up-to-date figures and entitlements there.
Perfect. There's another question here. Sorry. So, if being made redundant this year and received a tax-free lump sum back in 2015 by ex gratia, how much tax would I have to pay if I am leaving the role after 9.5 years? Is it 20% or 40%?
Can you repeat that, Ruth, just one more time? Sorry, I didn't
Yeah,
follow
no
suit.
problem. Sorry. So, if being made redundant this year and received a tax-free lump sum back in 2015 by ex gratia, how much tax would I have to pay if I'm leaving the role after 9.5 years? Is it 20% or 40%?
Well, firstly, like what you done in 2015 to some degree is kind of irrelevant to the tax you will pay on your redundancy payment. That'll boil down to your tax position this year. So like if your earnings this year are over 44,000 euro anyway, the amount that's not exempt will be liable to 52% tax, which is 40% income tax, USC and PRSI. What you done in 2015 might have a bearing as to which exemption you choose, but it's a very specific question and I need to know a bit more. So look, feel free to drop us a message, maybe or an email after the webinar. We can advise on it. Look, I'm just conscious of time, Ruth. So what we might do is just crack on with the slides, and we can always tackle some of the questions in a bit. Perfect. So what I just want to talk about now, guys, is just ways that you can potentially reduce your tax liability on that redundancy payment. And there's two main ways, okay? We kind of covered one of them there in the questions, which is making last minute AVCs. And AVC is just a fluff term for an increased pension contribution. It stands for additional voluntary contribution. So if you increase your monthly pension, that's an AVC. Or in this case, if you're making a lump sum contribution, that's also seen as an AVC. So you have to do this, okay, before you leave service. That's very, very important. As soon as you walk out the door, this opportunity closes. So every year you have scope to fund your pension dependent on your age and your earnings. So say you earned 80,000 euro last year and you paid 5,000 euro into your pension from regular monthly contributions. If you're in your 40s, the max that you can pay in is 25% of your salary of 80,000. So basically you can pay 20,000 euro gross into your pension. So that means if you paid in 5,000 last year, you've unused scope of 15,000 euro, and everyone actually has an opportunity to backdate a contribution to a previous tax year if it's done before the 31st of October or mid-November if you're doing it online this year. So potentially you can max out last year as well as this year with some of your redundancy payment or potentially maybe some of your accrued bonus. When it comes to the redundancy payment itself, some employers don't allow you to do it before. So if you have cash in the bank, sometimes you might have to finance the ABC from your personal your personal cash funds, let's say, or your savings, and then the redundancy payment would replenish that. But just to look at the numbers behind things, if you, let's say, made a 15 grand payment into your pension and backdated it to 2024, if you include it immediately in a 2024 tax return, revenue are going to give you 6 grand back. So you gave up 15 grand, the 15 grand goes into the pension, grows tax-free to your retirement, and revenue return you 6 grand almost immediately. So the net cost of making that contribution is only €9,000. So it's a really good return on your money, and it's reducing your overall tax bill by 6 grand, which is, lightening the tax burden on the tax that you're going to pay on your redundancy payment. As I said, it has to be done before your last day. Some employers will allow you to put maybe some of your severance payment in. Most of them should allow you to put some of like your bonus and your pile-on in and stuff, because that's just done through payroll in the normal manner. But if they don't allow you to put your redundancy package in, sometimes you might have to finance this from your savings, as I said, and then the redundancy payment will replenish that. The second option you have is something called the Employment Investment Incentive Scheme, or EIS for short. It's not for everyone, and it's not without its risks, but it remains the only thing in Ireland to get tax back at a high level outside of a pension scheme. It's basically a tax efficient investment scheme which allows Irish taxpayers to invest with qualifying Irish companies each year, generally over a maybe 4 to 5 year period or 4 to 6 year period. And the advantage of doing that is any amount of money that you invest in these qualifying companies, revenue will give you a tax rebate on that investment amount. Now, the amount of the rebate can differ depending on the company that you invest with. It can be 20%, it can be 35%, or it can be as high as 50%, depending on what stage that company are at. So like startup companies give you 50% relief. The reason the government support this is because they're trying to, flood more capital to young, progressive Irish companies who will hopefully, grow and contribute to economic growth and employment and all that kind of stuff. And the reason companies use it as a very, I suppose, as a way to raise capital, is it's a very cheap and efficient way to raise funds to grow. But just to give you an example, if let's say you had €10,000 that you were happy to invest in a qualifying EIS company, what happens is you get a cert for that investment, and next year revenue return you potentially €3,500 on that 10 grand investment. That's based on the example of a 35% relief rate, which is kind of the mid-tier relief. So in the first year, revenue is giving you 3.5 grand back on a 10 grand investment, which is only it's making the net cost of the investment €6,500, or how some people would look at it is they're only risking, say, €6,500 out of the €10,000. If the company is successful, after, let's say, 5 years, they could potentially return you your capital plus a return for the use of your money over that period. The average return is usually somewhere close to about 30%. So if you think about that, that's 13 grand potentially coming back to you in 5 years' time on an investment that had a net cost of just €6,500. So it's a double your money scheme if it all works out. But as I said, it does come with its risks. We've a lot of clients that want to look at the EIS scheme every year alongside their pension. So what Alpha Wealth does is we look around at some of the types of companies that are trying to raise EIS capital, and we'll generally maybe cherry pick 2 to 3 companies every year that we think are maybe the strongest options raising capital in that year, as a viable option for our clients within the scheme. So feel free to reach out to us over the course of the year, and we can maybe keep you updated on any opportunities within the EIS space. But currently, given that it's really early in the year, there is nothing to my mind. Any questions there, Ruth, that are worth addressing? Just try to clear out some of them.
There's a lot of questions coming in.
Yeah.
So one of the questions is ex gratia liable for USC, and PSRI?
Yeah, the amount that's not exempt. Sorry, just to clarify, sometimes you'll find that the exemption would actually absorb all of the redundancy payments. So you might be somebody who literally pays no tax at all on your redundancy because the exempt amount absorbs all of it. But if it doesn't, yes, you will pay income tax, USC and PRSI on the balance.
Perfect. Sorry, and the next question is, how is unpaid maternity 16 weeks impacting the annual income that is base for SBSE?
In truth, I'm not 100% sure. It's something I can maybe look into a bit further if you want to just link in with me after the webinar. But if I had to guess, I would say paid maternity would count towards your service in calculating your redundancy package, but unpaid maternity leave would not. That's what my thoughts would be, but I could stand to be corrected on that.
Perfect. Sorry, and then the next question is, so pension pot from employer pension converted into PSRA and still likely to be invested?
Yeah, all of your pension should be invested always, even in retirement. I mean, you're not going to stick your pension into a cash fund where inflation is just eating away the value. It's always important to have your pension invested. So a PRSA is no different to any other pension. Just to be clear, it's just like the wrapper of the pension, but like your investment options in general are pretty much the same, irrespective of what type of pension you're in. A PRSA is just a type of pension, but you can still invest the money, of course. That's kind of what I'll be discussing here now in a second.
And sorry, there's just one other question there as well. Can I claim the tax I pay on VR next year?
Sorry, what is that VVR?
I don't know. V.or, I can ask for more details on that.
Yeah,
Um,
if you want to just clarify that, whoever gave in that question, look, we'll maybe allow a bit of time at the end.
Perfect. And sorry, this one might have been asked earlier, but to use a portion of redundancy payment to form a new business, is there any tax exemptions available on this?
You, um, yeah, like so, like that's kind of not really specific to redundancy. It's probably one that you should run by your accountant or your tax advisor. Yeah, I'm sure there are, various tax incentives of investing your personal cash in a new business, like loaning money to a new company or a director's loan or something like that. But yeah, it's kind of beyond the remits of today's presentation, if you don't mind.
Sorry, and then there's just one other question. What is the impact best choice for someone aiming to move employment pension to PSRI?
Um, just repeat that very quickly, Ruth. Sorry.
Sorry about that. And what is the impact or the best choice for someone aiming to move their employment pension to PSRI?
Oh yeah, engage with an impartial broker like Alpha Wealth or somebody else who is reputable. Why? Because we can arrange PRSAs from every single main pension provider in the Irish market, and therefore make sure that you're getting access to the best funds. I've done this for loads of clients. I can, give you advice on exactly what's required. We can even arrange the certificate of benefit comparison, which is required through an actuarial company that we deal with, so we can make the process very, very seamless and make sure that your money is arriving in the very best possible place. That's kind of what I'm kind of going to be covering here now in the next couple of slides. So look, we'll just kick on and we'll go back to some questions in a while. So what I want to talk about now is just your pension options after leaving service, and we would stress that it is really important that people take action on this. Um, it has nothing got to do with what redundancy option you took. Really, anyone in Ireland who leaves a company should be taking a bit of action on the pension from that old employment. Okay, so you four main options when it comes to your pension from an employment that you've moved on from. One is to simply leave it where it is and access it at maybe 60 or 65, which is typically the normal retirement age or access point for company pension schemes. You then have an option to move it to a new employer's company pension scheme, which I'm not a fan of, because all you're doing there is just, losing a lot of options. Because if you move an old employer pension into a new employer pension, you're then tying up all of the money in the new employment scheme, where you can't access that until you leave or retire from the company, and you're moving it into kind of a restrictive scheme, maybe with restrictive investment options. The third one, and the one that tends to be maybe the best option for a lot of people, is to transfer it into a pension bond, a buyout bond, a personal retirement bond. They're all the same thing, which basically moves it into your name. You get the ability to access it from age 50 onwards, and you can invest it in any fund or any provider you want, therefore seeking out the best. A PRSA is the other option there as well. We can transfer it into a PRSA. You wouldn't necessarily be looking to transfer it into a PRSA unless you were utilizing this loophole, as I mentioned earlier. If you're not doing it for that purpose, you'd be just transferring it into the pension bond, which does not require a certificate of benefit comparison. All it really is just moving the pension into an arrangement in your name where you can access it from age 50. You've a bit more transparency and a lot more investment choice. There is a fourth option that only extends to people who were in their pension scheme for less than 2 years, and that is to take a refund of all of your payments less 20% tax. Now, this can be actually quite advantageous, and anyone who is in that bracket can kind of box clever. So, for instance, if I'm a top rate taxpayer and I'm getting 40% tax relief on my pension payments, and I'm only in my scheme for 6 months, and I know that I'm going to be made redundant in another 6 months, what I could essentially do, or I know I'm going to leave my company in another 6 months potentially, what I could do is max out my pension, get 40% relief on all of the money going in, and then take it all back out minus 20%. So I'm up 20% on the way back out. So the most important thing really when it comes to your pensions is where is your money invested? That is key. There's so many different funds, so many different fund managers in the market, and there's a massive variation between the returns of different fund managers. We want to see how it's performing. When I say that a pension fund is underperforming, I don't mean that it's losing money. Pension funds are supposed to grow in value. If they're not, there's something really wrong. But it's more about how your fund is performing versus the market or versus its peers or versus similar funds that are similar risk levels and have similar asset allocations. Your access point is important as well. Like if one of your objectives is to retire early at maybe 50 or 55, it doesn't really serve you well having your pension tied up in an employment scheme that has a normal retirement age of 60 or 65. So moving it to, I suppose, a personal retirement bond there where you can access it from 50 would make sense for a lot of people. And it is, very easy moving pensions. We can make it very, very simple and advise people on the process if anybody wants to get in touch, and we can provide reviews of any previous schemes that you have. What I want to stress as well is like that the strength of your employer is kind of irrelevant when it comes to the success of your pension. Sometimes I meet people and they have a pension behind in Apple, let's say, who's with Irish Life, and they think that because Apple is such a strong company, they should leave the money there. Your pension is tied to the success of that Irish Life fund, let's say. The strength of Apple has absolutely nothing got to do with it. So it's really about making sure that your pension is invested in the best performing funds and keeping fees low, of course, as well. Just to show you that not all pension funds are the same, I'm just after comparing a risk level 5 fund across some of the various main fund managers in the Irish market. The reason I've chosen a risk level 5 fund, that's 5 on a scale of 1 to 7, which would be a moderate to high risk fund, is it tends to be the most popular risk rating fund for pension funds in Ireland. So we have a couple of different fund managers here. We have Zurich, we have Irish Life, we have Mercer, who look after a lot of corporate schemes, and we have Aviva, obviously one of the big insurance companies here. You can see that Zurich's Prisma 5, which is their main risk level 5 fund, has averaged nearly 69%. Sorry, it has returned 69% over the last 5 years. So it's been averaging about 10% per year over the long term. Whereas if you look at this Irish Life fund, the same risk level, it's done less than half of that. And then, weirdly enough, there is another Irish Life fund, which has actually done better than the previous Irish Life fund, despite being the same risk level also. So sometimes if your pension is with, say, an Irish Life and you can't move, it's a case of getting information on all of the options that are within that scheme and making sure that you're in the best of a bad bunch, potentially, and we can give you a bit of advice there. Mercer have returned 46% on their main risk level 5 fund, and Aviva 37%. So you can see there that like over the long term, there could be a difference of anywhere from, 3, 2, 3, 4% per year, I stress, between different funds at the same risk level. And that's huge, like if you take a 2 to 3% difference on a very large fund value, let's just say we 50 grand growing at 4% per year for the next 30 years, it would be worth 162 grand in the future. Whereas if we take the same 50,000 euro growing at 6% per year for the next 30 years, that's an extra 2%. That's 287,174. So there's over 100 grand there difference in the difference over the 30-year period. So if you're ignoring a proper review of your funds, or you're sitting in funds that you think are, doing okay, but in reality it might not be, you could potentially be costing yourself hundreds of thousands of euro. So even though today's presentation is very much based on redundancy and how you take your redundancy package and what your options are, your pension, what you decide to do, that is much more important, because the opportunity cost is absolutely huge compared to the tax that you're going to pay on a redundancy payment. What you also might want to consider if you are leaving your employment is any benefits that you might lose. So you have things like debt and service, which is life cover that you have through the company, let's say, to protect your dependents in the event of your death. You have income protection, which ensures your salary, or you might have health insurance. So sometimes if you're not moving into another employment straight away that provides these benefits, you might want to consider affecting personal policies to protect you and your family in the event of losing these types of things. I meet a lot of people as well that have quite a lot of shares built up in their own old employments or even in their current employments. And you do need to get a bit of advice there as well, because we never want to have too much exposure to one particular company. And yeah, and it is wise, like not only from a tax perspective, but from an investment perspective to, sell those shares and diversify into a, more balanced portfolio. And that can even lead to better returns at lower levels of risk. Do you want to maybe tackle a couple of questions there, Ruth, before we move on to the next section?
Yes, there's a lot more questions coming in now again. Just in regards to that, like previous question on VR, so the VR stood for voluntary redundancy. So the question was, can I claim back the tax I pay on voluntary redundancy next year?
Um, no, like if the tax you pay on a redundancy, it's no different like to the tax that you'll pay on your salary. Your only way of claiming tax back is by claiming tax back on things like medical expenses, working from home, and pension contributions or EIS investments. Well, pension contributions, which is kind of the biggest, the most powerful tool in your armory to reduce your tax bill. There's no kind of specific thing that you can claim tax back on just because you took voluntary redundancy.
Thanks. Okay, great. Sorry, so there's more questions here. So as a PAYE employee being made redundant, am I allowed to draw down 25% of my pension pot value after receiving a redundancy payout? And if so, are these two lump sums treated differently for tax purposes?
Yeah. So assuming you didn't waive your right to a pension lump sum from your redundancy, you could take your redundancy payment tax-free this year. And if you were, and then walk out the door of your company, move your pension to a personal retirement plan. And if you were 50 next year, you could draw on that and take 25% of it. So yeah, absolutely, it is possible. And that's why, it's important to maybe engage with an advisor like ourselves just to get a bit of advice around that. I would stress, however, that even though you can access a pension from 50, it doesn't make sense to unless you are actually going to retire. Because if you're not going to retire until 60, there's no real point taking 25% out of your pot at 50, because you're stopping a quarter of your fund that would otherwise be growing tax free up until 60. So it'll result in a lot less money for you down the line. Basically, but yeah, if you're going to look at early retirement or if you really need the funds, look, yeah, it's certainly an option.
Perfect. Sorry. So in relation to redundancy options, will we be given clearly on paper the options we can choose for how our redundancy is going to be paid out and how much tax we will be charged on it?
Yes, sorry, let me correct myself. You absolutely should be giving them on clear paper, but I have seen, some really shoddy excuses of redundancy options. Like I've seen cases where the company have sent on an Excel tool to employees and asked them to make a decision in the next couple of weeks. So yeah, it differs, but you definitely should, like it's the standard between good companies would be to get, let's say, a big accountancy firm on board and get them to do the calculations and do up the options and engage with the employees and give them the advice. So you certainly should, but if you don't, feel free to link in with ourselves and we can go through it with you as well.
Perfect. Sorry, I'll just give you one more there now. How will accrued annual leave be paid out?
Um, so it's just kind of as a normal salary. Let's say it's just usually goes through payroll in the normal manner where it's subject to USC, PRSI, and income tax.
Sorry,
Perfect.
okay, one last one
We
here now as
Yeah, we'll
well.
go for one more and then we'll just allow a bit of time at the end because I'm conscious of time as well.
Perfect. Would you keep an old employment defined benefit pension or amalgamate everything on a PSRA?
Yeah, so that's a very good question. Okay. Defined benefit pensions are very different because defined benefit pensions are a promise of future income per year rather than a fund value. So waiving your right to a pension lump sum doesn't always necessarily relate to defined benefit pensions. Now, sometimes with a defined benefit pension, you have an option to commute some of your pension, which means give up a portion of the annual future income for a lump sum payment now. So you could lose that. Also, if you were making ABCs and building up an ABC fund in addition to the defined benefit pension, you might be waiving your right to some of that. So again, it's a very specific question, and I'd need to know a lot more information on your kind of situation and your pension details to give you the advice. Perfect. So what I just want to talk about now is getting redundancy lump sums to work. Because look, if anybody is on the call that's going to be getting a sizable, I suppose, an amount of money hitting their bank account in the near future, we never want to be in a scenario where that's just sitting there. I mean, like, shocking statistics from the central bank show that Irish savers have 160 billion sitting on deposit, and 90% of that, that's €9 out of every €10, is in current accounts or demand deposit accounts, earning little to no interest. So like less than 1%, near 0% in most cases, which is completely unacceptable. Like, nobody on this call should be accepting 0% interest on their savings, particularly given that interest rates have gone up a lot in the last couple of years. So firstly, when it comes to saving money or putting away an amount of money, there is this distinction between, is it a short-term need, i.e., what's the potential that you might need it in the next 4 years? In that case, the best option is usually the online banks. So that's like the Raisins, the Revoluts, the Trade Republics, which tend to give better returns than the Irish banks. And a lot of them are actually stronger than the Irish banks. I'll talk a bit more about that in a second. But more medium to long-term savings, so money that you don't need in the next 4 years, it should be invested, because we want to make sure that your money is growing and outperforming inflation. Otherwise, you're just losing purchasing power and you're going backwards. So when I talk about these online banks, I usually talk about the likes of your Trade Republics, your Raisin.ie's. Trade Republic and Raisin are two excellent providers that I usually talk about, and they're currently giving rates as high as 2.93%. It is gross, of course, and it is liable to dirt, so it nets down to about 2%. So you can get about 2% after tax. So that just needs to be updated, because we have had a rate cut. So it's about 2.81% now, I think, is the best rate. So I think it reduces down to about 1.88%, which is still quite decent. Now, I see a lot of people, they come to me and say, Jesus, David, you're talking about 2.8% in Raisin. Sure, I've seen Revolut advertise 3% or 3.89%. Sometimes you need to look beyond the rate, okay, because a lot of the accounts that Revolut advertise are what they call flexible cash funds. One of them involves you holding money in US dollars and therefore taking on currency exchange rate risk. And then the other one is having money in something called a money market fund. There's two downfalls of that. One is, because it's a fund and it's not a deposit, it's not insured under a bank deposit guarantee scheme, which is the same situation we have here in Ireland, where if a bank fails, the government in the country that that bank is situated in will insure the money in the account up to, say, €100,000. And that's the case with a lot of these Raisins and Trade Republics. They are insured by deposit guarantee schemes. Whereas if you have money in a flexible cash fund or a money market fund, it's not covered under the same deposit guarantee schemes. Also, because it's a fund, it's taxed at an exit tax rate of 41% and not dirt tax of 33%. Revolut's normal rate, just their basic rate, which is protected and it's held by a bank, is actually just 1.7%. So just make sure that you're not going into anything that comes at, a high degree of risk and is not protected. What I have here on screen is some of the current rates from Raisin. So a lot of people ask me, how safe are the online banks? And I say to them, in a lot of cases, they're safer than the Irish banks. And if you see here on screen, these are 3 Swedish banks that you can access through Raisin. And there's a series of letters after the bank. They're 3As. That's a AAA credit rated financial institution. It's the highest possible credit rating a bank can have. It's the same credit rating as the US Federal Reserve. Most Irish banks are a B credit rating, so you can get a better interest rate with a stronger bank covered under the same deposit guarantee scheme through some of these online banks. But as I said, it is only really for money that you need or plan on needing in the next 4 years, because even after tax, it's not going to produce a return which outperforms long-term average inflation. So we do need to get longer-term monies working a lot harder. And therefore, I would recommend that people check out some of the regular savings or lump sum investment options through some of the insurance companies. We deal with all of them. You can generally get returns anywhere from 5 to 10% per year. There are accessible options there. They allow you to benefit from compound interest, which Albert Einstein described as being, one of the ninth wonder of the world. And it allows you to get access to very diversified portfolios. It's very flexible in that you can alter the contributions, increase, decrease, take out, start, stop, etc. And they've generally given returns which far exceed inflation. we set up something a couple of years ago called the Alpha Savings and Investment Club, which was basically there to educate Irish savers on the alternative options out there outside of the main Irish banks. And we basically use what we believe is the best savings plan in the Irish market. You can save into it on a monthly basis from as little as €100 per month. It's very flexible in that you can increase, decrease. As I said, there's no encashment penalties. You can also put a lump sum into it from €5,000 upwards, and it allows you to access a wide range of savings funds with very long-term track records. It's an excellent plan for saving for any long-term goals such as children's education. We also set it up at some of the lowest fee structures in the Irish market. We give you 101% allocation on your money to cover the 1% government levy to make sure all of your money is invested. The Zurich Balance Fund is of one of those funds that we use in the Alpha Savings and Investment Club. It was one of the oldest and most popular funds in the Irish market, launched in the 1980s. It's got a 35-year track record. So you talk about dot-com bubble, 2008 financial crash, COVID, war in Ukraine, Brexit, Donald Trump getting elected twice. It's been through the lot and it's been very, very resilient. It's managed by Zurich, who are one of the largest investment managers in the world. So you're getting a lot of experience there and completely kind of, a very convenient account for you because you don't need to manage it yourself. It's a very diversified fund giving exposure to over 600 assets. So it's giving you huge levels of diversification at very low entry levels. And it's produced annual average returns of about 10% per year, minus a management fee, which can be maybe 1 to 1.5% per year, depending on what's going in. So what you have here is a very well diversified portfolio, which is accessible, and it's produced a net return which far exceeds inflation. And we're happy to talk to people a bit more on that. Just to mention that not only do we focus on redundancy, we also run quite regular financial webinars across a wide variety of different topics. I just want to talk about our next two ones coming up. I touched on company shares a little bit earlier. I will be doing one devoted to shares on the 13th of March, and I'm going to have Dara McCormick on, who is an accountant and a tax specialist. Dara is really experienced when it comes to employee share saving schemes, your RSUs, your share options, what your tax treatment is, what your considerations are. And then we'll also be talking about what to do with your shares and the best way of kind of structuring those and making the most out of that benefit. My colleague Nick will be doing another one on the 27th of March, which is based around this concept of financial independence, retire earlier, FIRE. So people that want to, get themselves into a position where they can step back and take life a little bit easier, maybe a lot earlier than, you're 60 or you're 65, which is your traditional retirement years. So yeah, retiring early, basically. You can register for both those webinars on our website or by by scanning the QR code there. And if anybody wants to speak to us in a bit more detail on your own situation, we provide two very good comprehensive financial planning reviews in Alpha Wealth. We have our core service and our review service. You can check them out on our website there, or you can book in for a consultation by emailing info@alphawealth.ie, emailing myself, dlooney@alphawealth.ie, or else scanning the QR code or visiting our website, alphawealth.ie. So look, I'd like to thank everyone for their time, and I might just spend the next couple of moments maybe answering any of the questions that we didn't get time to.
Yeah. Look, as I said, there's a lot of questions and we'll try to get to as many as we can.
Yeah, I'll just take a
Just
sip of water and get ready here now.
go for it. Can we reap the same tax benefits of EWS by choosing a portfolio of eligible firms rather than one?
Yeah, like I mean, you can invest in loads of individual companies, so you're not tied to one company, but there's not a whole lot of them out there, and there's not a whole lot of good ones. Like a lot of them are startups, but there are companies like BVP is one that we work with every year, and they have an EIS fund where they raise money in the fund and then they deploy that to certain companies. But as I said, like you're not going to have a fund made up of blue chip companies, because EIS is more for kind of smaller early stage companies.
So just in relation to maternity benefit again, so is maternity benefit included in your SCSB earnings calculation given it is a taxable income?
I'm not 100% sure, but as I said, like your SCSB calculation is based on your earnings from your employment and your service with your employment. So if you're on unpaid maternity, that's mightn't be regarded as service with your employment, and it's certainly not regarded as remuneration directly from your employment, so possibly it wouldn't be included in it. Again, I could stand to be corrected there.
Perfect. Sorry. And then just in relation to the consultations, how much would a consultation cost to go through the redundancy calculations?
So we have two consultation offerings. We've our core review, which is 199. Both fees, by the way, are once off. They cover the initial consultation, any subsequent meetings and advice, potentially setup of any plans. They're kind of a once-off cost. But we also have our platinum review, which is for individuals who are earning over €100,000 a year, couples who are earning over 150,000 a year combined, or have investable assets of over 100,000, or business owners. Reason being is that they just have more complex financial needs, and we focus on more things like, tax and estate planning, tax planning, that kind of stuff. So yeah, it can range from 199 up to 349, but it is once off, as I said, and you'll get a lot of benefit from that.
Perfect. Sorry. And then just in relation to recovering past pensions, does Alpha Wealth help with recovering pensions and shares from previous employment with under 2 years of service?
Yes, we can as part of a financial review. As part of a financial review, we can get you to sign something called a letter of authority. It's a one-pager, and we basically then send that away to any, say, pension providers that you had a pension with in old employments to get the information and then give you advice on how it's doing, let's say, as well as any options. And look, if we can, progress to whether it makes sense to transfer or take the money out or something like that. So yeah, as a review, we can certainly look at that.
There's a lot of questions still, just but I suppose I'll do a few more, right? There was
Yeah, that's
one here that says, is an ARF the same as a PRSA? PRSA,
No.
sorry.
An ARF is a post-retirement pension. So if you have a company pension, a PRSA, a personal pension, any type of pension, how you access it usually is you take 25% of it as a tax-free lump sum, and then the balance of that goes to an ARF. And that's basically just a post-retirement fund that you draw regular income from. So it's basically just kind of keeping money within the pension fund, but you drip feed income to yourself to provide yourself with a regular income.
And then just in relation to fund fees. So what are the fund fees we should be wary of while choosing funds under pension pots? What is the ideal management fee to look at?
Um, Fees are important, okay, but they're not everything. Sometimes it's a case of you pay for what you get. So, for instance, if you are in an employment scheme with 500 members, that scheme has massive buying power. So you might find that the annual fund management charge is quite low at, let's say, 0.5% per year. And if you want to move out to a personal arrangement, that's a once-off arrangement. So you can't possibly get the same management fee as a 500 member scheme. So you might be paying a management fee of 1.25, maybe 1.5%, who knows? But you might be in a fund in the new arrangement that has been averaging about 10% per year, whereas the equivalent fund in your scheme might only be doing 5-6% per year. So the difference in the management fee is far outweighed by the difference in the fund performance. So it's about looking at everything, and we'll help you, go through that.
Perfect, sorry. And then the next question is, if you waive if you waive the pension tax-free lump sum, then what tax rate is charged on the pension lump sum taken later?
So how pensions are drawn, okay, is 25% of the fund as a lump sum. First 200,000 is tax free. Next 300,000 is taxed at 20%. That's within the 25% lump sum. The balance goes to an ARF where it continues to stay invested, although much more conservatively at that point in your life. Any interest that it earns is still tax free because it's in a pension and you draw annual income from it. How much you take out of that and how much tax you pay on it will depend on your overall income position. Most people in their retirement years, they'll only be paying income tax at 20%, because like I rarely meet clients that have a high enough pension fund to sustain withdrawals of 44 grand a year in addition to the state pension. So you're not going to push yourself over that top rate of income tax threshold. So it's not something I'd be worried about paying, loads of tax down the line in retirement.
Perfect, sorry. And then the next question is, do you recommend Bunk as a bank?
Yeah, they're decent, but the issue is like they don't have better rates than some of the other providers. So like you have, I think Bunk's rate is 2.67, but you can get 2.81 in Raisin with those Swedish banks I referred to earlier.
Perfect. Sorry. And then the next question is, aside from investment funds, are there alternative options which offer diversification, profit, or possibly ETFs, etc.?
An ETF is the exact same as an investment fund. An ETF is an exchange traded fund. It's just a fund made up of loads of different stocks and shares. The issue you have with ETFs is, firstly, they're all stocks and shares, and therefore they are high risk. Then they're maybe specific on a certain region, like the S&P 500. So that's the North American equity market, therefore ignoring the other world. And it's all in stocks and shares, as I said. So sometimes it's important to have more diversification within a fund. So like add bonds, add alternatives, which is reducing your risk and reducing your volatility.
Perfect. And then, sorry, the next question is, how can you get 1.5 times your salary as a tax-free lump sum from your PSRA upon retirement? Any downsides to doing this versus taking 25%?
Yeah, if you have like like if you've like a director's pension, or sometimes there is another calculation of the lump sum at retirement basically, and it is something called a salary and service lump sum. But it can be 1.5 times your salary if you have a director's pension, or it can be, more than 25%, depending on your salary and service. But with that, you're usually forced to use the remaining fund value to purchase an annuity, so you don't have the ARF option. And I'd say less than 5% of people nowadays purchase annuities because the rates are really poor and they're very inflexible, and usually they die with you. Whereas an ARF it usually gives a lot more benefits and bang for your buck, and it's flexible in that you can draw more in the earlier years and less in the later years and all that kind of stuff. Look, I can be here all day explaining the pros and cons of either, but yeah, that is the risk of going with that.
Perfect. Thanks, David. I think that's the last of the questions.
Perfect. Yeah. So look, I appreciate we've been on for over an hour and 5 minutes. So for anyone who's still on the call, thank you so much for your time. Look, I hope you got some benefit, and look, you're more than welcome to link in with us after if you want to discuss your own situation. So look, enjoy the rest of your evening, and best of luck for the rest of the year, everyone. Thanks, Fruit, as well.
Thanks, everyone. Thank you.